In case you are still hiding under a rock, the Bank of Canada just raised the interest rate for another quarter to a total of 1.5%. Since March of last year, interest rate has risen for the 8th time in a row. Not shocking, this is pretty much what most people predicted. What does this mean in Canada, particularly in Toronto real estate? Don't go away, let's talk about it right after this. Hi, welcome back to AV Team Real Estate Channel. I'm your host, Antonio, a local real estate agent in the GTA. If you are new here, welcome to the channel where I post all real estate content in the Greater Toronto area. If you like it, don't forget to hit the like button and consider subscribing to our channel. Or if you'd like to chat with me just to get a general idea of what's going on in the market, feel free to book a call with me using the first link in the description below. It is really quick and easy. Okay, it was just last week when the Bank of Canada announced the latest interest rate rise on January 25th. But it is interesting to see the body language of Tiff's speech, so let's hear it and analyze it together.
Monetary policy report. Our policy decision today has two elements. First, we raised our policy interest rate by 25 basis points to 4.5%, and we are continuing quantitative tightening. Second, if economic developments evolve broadly in line with the forecast we published today, we expect to hold the policy rate at its current level while we assess the impact of the cumulative 425 basis point increase in our policy rate. We've raised rates rapidly, and now it's time to pause and assess whether monetary policy is sufficiently restrictive to bring inflation back to the 2% target.
Basically, there are two major elements announced. The Bank of Canada decided to raise the interest rate by 0.25 basis point to a total of 4.5% overnight lending rate, and then announced that it would be paused. One of the most talked about topic in town at the start of the year in 2022 would be the highest inflation rate since the 1980s. Let's quickly take a look at this number from December last year. If you were going to the grocery store, I'm sure you will see that eggs, butter, lettuce, and food in general were so expensive. I still remember going to Harvey's and burrito places where they are forced to replace the lettuce or have no lettuce at all. Clearly, inflation is out of control, reaching 9.1% in June of 2022. But let's hear what he got to say about the results so far from the rapid interest rate rise.
Demand in the economy has persisted, putting continued upward pressure on prices. Simply put, our overheated economy has not cooled as much as we expected. Global supply chains, on the other hand, are resolving more quickly than expected. And while we're not back to normal yet in Canada, we have seen substantial progress. CPI inflation declined to 6.3% in December, reflecting lower energy prices and some moderation in the prices for durable goods as supply improved and demand softened. Lower gasoline prices are welcome, but prices of essentials like groceries and rent continue to increase too quickly. Measures of core inflation have also been stuck at about 5%. With 3 months rates below year-over-year increases, core inflation will likely start to come down in the months ahead. Still, core inflation needs to continue to decline for total CPI inflation to get back to the 2% target. Regarding expected inflation, our surveys indicate that fewer households and businesses think inflation will stay high for a long time, but short-term inflation expectations remain elevated and are above our own inflation forecast. Based on these assessments, the Governing Council concluded that a further modest increase in the policy rate is appropriate.
That is as expected. Based on these assessments, they decided to raise the interest rate. Like I said earlier, there are no surprises since the goal was to reach 2% inflation. Although we managed to lower it from the peak of 9.1% to 6.3% in December, it is still far from the 2% target.
Looking ahead, we know it takes time for higher interest rates to work through the economy to slow demand and reduce inflation. And given the speed and magnitude of the interest rate increases over the last year, their full effect is still to come. We can also see that the interest rate increases we've undertaken to date are already working. Higher interest rates are slowing household spending, and inflation is coming down. With today's modest increase, we expect to pause rate hikes while we assess the impacts of the substantial monetary policy tightening already undertaken. To be clear, this is a conditional pause. It's conditional on economic developments evolving broadly in line with our NPR outlook. If we need to do more to get inflation to the 2% target, we will. We're trying to balance the risks of under and over tightening. If we do too little, the decline in inflation will stall before we get back to target. If we do too much, we will make the adjustment unnecessarily painful and undershoot our inflation target.
This is simply stating that the second element of the major announcement that they will intend to pause the interest rate after this one. But just be cautious, it is a conditional pause. He emphasizes that it will be kind of a test to see how the market reacts to it, and if the inflation keeps rising, the Bank of Canada will not hesitate to raise the interest rate again, signaling that their focus is on the inflation and that they are willing to sacrifice being in a recession. In addition, he also mentioned that on February 8th, the Bank of Canada will announce a more detailed summary and see what core inflation looks like, which could help us determine the outlook ahead.
In Canada, the economy remains overheated and clearly in excess demand. Tight labor markets have shown only modest signs of easing. Job vacancies have come down a little, but remain elevated. The unemployment rate is near historic lows, and many businesses continue to report labor shortages. But as I said, higher interest rates are working to help the economy rebalance. Household spending has moderated. Demand for furniture and appliances has decreased, and housing market activity and prices have declined substantially. As pent-up demand diminishes, spending on services should ease. Higher interest rates are also expected to continue to slow business investment, and weaker foreign demand will weigh on exports. Putting this together, we expect growth in Canada to stall through the middle of this year before picking up later in the year. We project that on an annual average basis, growth in Canada's GDP will slow from about 3.5% in 2022 to about 1% in 2023 and 2% in 2024.
This part is a short projection of what they anticipate for this year and 2024. Nobody knew what was going to happen. The Bank of Canada prediction was way off in the past, so take it with a grain of salt. But at the very least, we can see what the core values are that they are taking into account. At the end of the day, what does this mean moving forward? They predict that economic growth will slow until the middle of 2023 before picking up later this year. The annual projections were that the GDP in 2022 would slow from about 3.5% in 2022 to 1% in 2023 and 2% in 2024. As an active real estate agent, of course, I can speak for myself and some other realtors who have quite a few buyers sitting on the sidelines. I guess most buyers are playing the wait and see game. At this point, the mood of the market is quite volatile. But on the contrary, I spoke to my fellow mortgage guy, and in this market, it was quite busy. You may ask why sales and transactions were down at such a drastic rate, and yet they are still so busy. I'm sure if you're shopping around for mortgages or looking to renew your mortgage, you have most likely been informed that the rate has gone way above 5% or 6%, depending on the bank. But if you find a really good mortgage agent, the one that has a lot of business with the major banks, believe it or not, they can still get a reasonable rate under 5%. You may wonder why not all can offer that. I ask the same questions, but I guess this rate is only offered to those who have been in a long-term relationship and businesses. And sometimes you will also think that you have to have something like a 20% before you can enter the market. Although some people have a decent income, including their spouses, they don't realize that the combined income could actually be enough to purchase the property that they are interested in without the deposit. The idea is that you have to speak to an experienced mortgage advisor. I know what you're thinking. You would think that is some kind of gray area to make up the income or commit other mortgage fraud in order to get a qualified. There are other correct ways to do this, but the problem is that not many people know about them, so they just think it's a waste of time to speak to a mortgage specialist who could assist you. The advantage is that by doing it now and take advantage of the discounted property that is currently on the market, you can leverage your income and bypass the waiting time until you save up the deposit, which may take a few years. As I previously stated, you may be unaware that you are qualified to purchase a home because you have heard news or headlines that have scared you away. Even though I've seen people with combined income just above 100,000 who can start with a condo unit and then upgrade to a larger home in a few years. Although you may believe that the market will crash and interest rate will rise, if you dig deeper, you will find that mortgage broker can offer lower interest rates even with the primary banks. I thought the same thing, but when you spend time looking, you may be surprised that it is not what the news says. It is really the media and new headlines that make it seem so. Just for example, if you talk to most bank or mortgage broker, you may hear the average rate is about 5 to 6%, but even today, I've spoken to some other brokers who have done many deals this year that could get mortgage below 5% with AAA lender. And I was fascinated with the option that you may have when you recently got a job offer with a good salary but are shy of getting the deposit for a home. For most, they just turn away and waited until they save up, but I've seen alternatives that could get them going. That is why some mortgage brokers were even busier now than before the interest rate hike. I guess that is why it is important to speak to more people, and you may be surprised why some people get more opportunities than others. Every situation is different. I'm not saying that I could guarantee anything, but I think there are far more options that you may think. If you fall under one of the scenarios that I mentioned earlier, don't hesitate to contact me so that I can hook you up with a mortgage broker who has helped many of my clients purchase property that they didn't think was possible. At the end of the day, you are thinking long term for your real estate investment, like 5 or more years. I'm pretty confident that you will do fine. And with that mindset, you will be less stressed looking at the short-term fluctuation of home prices, especially in this rapid rate rise over a span of 10 months. Anyways, I'll end the video right here. If you wish to chat with me, there is a link below in the description, or simply shoot me a message. I hope you have a wonderful day, and I'll see you in the next video. Bye.